Picture a server room in Singapore in early May of 2022. Rows of computers hum quietly in the controlled climate, their lights blinking in rhythmic patterns. On screens around the world, a number that was supposed to stay constant is beginning to drift. $1. That was the promise, the foundation of everything. But now the number reads 98 cents, then 95, then 90. In chat rooms and forums, the first questions appear. Is this just volatility? A temporary glitch? Or is something fundamental breaking? What happens when a digital currency designed to hold its value through mathematics alone starts to lose the trust that holds it together? And what can investors learn from watching $40 billion of value vanish in less than a week? Before we venture deeper into this story, take a moment to like this video and subscribe, but only if you're drawn to the kind of financial history that reveals patterns beneath the surface. And if you're still listening, leave a comment telling me where you're tuning in from tonight and what brought you to this moment. You might be listening to this as you wind down for the evening, perhaps after scrolling through crypto news or checking your portfolio one last time before bed. This story is not here to tell you what to buy or to stoke fear about any particular investment. It is here to help you understand how complex financial systems can unravel, how confidence and mechanics intertwine, and why the lessons from Terra and Luna matter for anyone thinking seriously about where to put their money. So settle in, let your mind relax, and let us walk through this chapter of crypto history together. The world that gave birth to Terra and Luna began with a problem that the cryptocurrency space had been trying to solve for years. Bitcoin and Ethereum, the flagship digital assets, were too volatile to use as everyday currencies. Their prices could swing 10 or 20% in a single day. This made them interesting as speculative investments or stores of value, but impractical for buying coffee or paying rent. What the crypto ecosystem needed was a stable digital dollar, something that could move across blockchains quickly and cheaply, but maintain a predictable value. This need gave rise to stablecoins. The first generation of stablecoins took the straightforward approach. Companies like Tether and Circle created tokens that were backed one-to-one by real US dollars held in bank accounts. If you wanted to create 100 USDT tokens, the issuer would hold 100 real dollars in reserve. If you wanted to redeem your tokens, you could exchange them back for those dollars. It was simple and it worked, but it required trust in the company holding the reserves. It also meant that these stablecoins were subject to banking regulations and the traditional financial system that many crypto enthusiasts wanted to escape. Some developers began to wonder if there was another way. Could you create a stable digital dollar without holding actual dollars in a bank? Could mathematics and incentives replace trust in institutions? This question led to the concept of algorithmic stablecoins. Instead of backing each token with a real dollar, an algorithmic stablecoin would use code and market forces to maintain its peg. The idea was elegant in theory. If the token traded above $1, the system would mint new tokens to increase supply and bring the price down. If it traded below $1, the system would burn tokens or create incentives to reduce supply and push the price back up. No bank accounts needed, no regulators to worry about, just code running on a blockchain. Terra was one of the most ambitious attempts to make this vision real. It was launched in 2018 by a company called Terraform Labs, founded by Do Kwon, a Stanford-educated entrepreneur from South Korea, and Daniel Shin. The Terra blockchain was designed to host a family of stablecoins, each pegged to a different currency. Terra USD or UST was pegged to the US dollar. Terra KRW was pegged to the Korean won. The mechanism that kept these stablecoins stable involved a second token called Luna. The relationship between UST and Luna was the heart of the system. Luna was the volatile token, the one that could fluctuate in price like Bitcoin or Ethereum. UST was supposed to stay at $1. The protocol allowed anyone to mint UST by burning Luna, or to mint Luna by burning UST. The exchange rate was always $1 worth. So if Luna was trading at $50, you could burn one Luna token to create 50 UST tokens. If UST started trading above $1, say at 1.05, arbitrage traders could mint UST by burning Luna and then sell that UST on the open market for a profit, increasing the supply of UST and pushing the price back down to $1. If UST started trading below $1, say at 95 cents, arbitrage traders could buy cheap UST, burn it to mint Luna, and sell the Luna for more than they paid for the UST. This would reduce the supply of UST and push the price back up. It was an elegant dance of supply and demand, a self-correcting mechanism that relied on profit-seeking traders to maintain the peg. For years, it seemed to work. UST grew from a small experiment to one of the largest stablecoins in the crypto market. By early 2022, there were more than 18 billion UST tokens in circulation. Luna, the volatile counterpart, had reached a market capitalization of over $40 billion. Do Kwon became a celebrity in the crypto world, known for his confidence and his willingness to defend Terra aggressively on social media. The Terra ecosystem attracted developers, users, and billions of dollars in capital. Part of what made Terra so attractive was a protocol built on top of it called Anchor. Anchor was a lending and savings platform that offered an astonishing 20% annual yield on UST deposits. 20% was far higher than anything available in traditional finance, where savings accounts paid less than 1% and government bonds offered only a few percent. For investors searching for returns in a low interest rate environment, 20% on what was supposed to be a stable dollar equivalent was irresistible. Money poured into Anchor, and most of that money was in the form of UST. This created a feedback loop. People bought Luna to mint UST so they could deposit it in Anchor to earn 20%. The demand for Luna drove its price higher, which made the Terra ecosystem look more successful, which attracted more users and capital. But beneath the surface, there were questions that some observers were beginning to ask. Where was the 20% yield coming from? Anchor was not generating enough organic revenue from its lending operations to pay all its depositors. The yield was being subsidized by a reserve fund, which was essentially paying out money to keep the advertised rate attractive. That reserve fund was not infinite. More fundamentally, some analysts questioned the stability of the UST peg itself. The mechanism only worked as long as people believed in it. If UST fell below $1, arbitrageurs would only buy it and burn it for Luna if they believed Luna had value. But Luna's value came largely from the demand to mint UST. If confidence in UST collapsed, the whole system could enter a death spiral. UST would fall, people would try to redeem it for Luna, flooding the market with newly minted Luna, which would crash Luna's price, which would make UST's peg even harder to maintain. This risk was not hidden. It was discussed openly in crypto forums and articles. Duquan and Terraform Labs were aware of it. In the months leading up to May 2022, they made efforts to strengthen the system. They established a non-profit foundation called the Luna Foundation Guard, or LFG, which began accumulating Bitcoin as a reserve to help defend the UST peg. The idea was that if UST came under pressure, the foundation could sell Bitcoin to buy UST and support its price. By early May, LFG had accumulated more than $3 billion worth of Bitcoin. This was presented as an additional safety net, a backstop that would give the market confidence. The economic backdrop of early 2022 was challenging for all risk assets, not just crypto. The U.S. Federal Reserve had begun raising interest rates to combat inflation. Stock markets were falling. The mood in financial markets was shifting from optimism to caution. Risk appetite was declining. In the crypto space, prices had been sliding for months. Bitcoin, which had peaked near $70,000 in late 2021, had fallen below $40,000. The entire crypto market capitalization had dropped significantly. This was the environment in which Terra's stability would be tested. The first signs of trouble appeared on Saturday, May 7th, 2022. UST began to trade slightly below its $1 peg, dropping to around 98 cents. This kind of small deviation had happened before and had always corrected itself quickly. Arbitrageurs would step in, the mechanism would work, and the peg would restore. But this time felt different. The deviation persisted. On Sunday, it widened. UST was trading at around 95 cents. People who had been quietly worried about Terra's mechanics began to move. Some large holders started withdrawing their UST from Anchor and selling it. The selling created more downward pressure. UST fell further. On Monday, May 9th, the situation escalated. UST dropped below 90 cents. Panic began to spread through the Terra community. On social media and in chat groups, people were asking whether they should pull their funds out. The Luna Foundation Guard announced that it was deploying its Bitcoin reserves to help stabilize UST. They began selling Bitcoin and using the proceeds to buy UST. This created additional pressure on Bitcoin's price, which fell sharply that day. The crypto market as a whole was now watching Terra closely. What had been a localized problem for one stablecoin was beginning to affect sentiment across the entire space. As UST fell, the minting and burning mechanism kicked into high gear. People who held UST started burning it to mint Luna, hoping to salvage some value before things got worse. This minting process created enormous amounts of new Luna tokens. Remember, the protocol allowed you to burn $1 worth of UST to create $1 worth of Luna at the current market price, but as billions of UST were burned, billions of dollars worth of new Luna flooded the market. Luna's price began to collapse. From over $80 per token just days earlier, Luna fell to 50, then 30, then 10. The death spiral that analysts had warned about was now happening in real time. The more UST fell, the more people tried to exit by burning UST for Luna. The more Luna was minted, the more its price fell. The more Luna's price fell, the less confidence people had in UST. By Tuesday, May 10th, UST was trading at around 50 cents. Luna was in single digits. Trading on exchanges was becoming chaotic, with massive volatility and slippage. Some exchanges temporarily halted trading in Terra assets because the price movements were so extreme. Do Kwon and Terraform Labs tried to respond. They proposed emergency measures, including a plan to mint more Luna to try to restore the UST peg. But minting more Luna only accelerated the collapse. Validators on the Terra blockchain voted to halt the chain temporarily to prevent further chaos. When it resumed, the situation had not improved. By Wednesday, May 11th, UST was trading at around 30 cents. Luna, which had once been worth over $100 per token and had a market cap of over $40 billion, was now worth pennies. The supply of Luna had exploded from a few 100 million tokens to trillions of tokens as the protocol minted desperately to try to absorb the UST being burned. The human stories behind the numbers were devastating. Retail investors who had put their savings into Anchor, believing they had found a safe place to earn 20% on a stable dollar, watched their holdings evaporate. Some people had taken out loans to buy Luna, convinced that it was going to $1,000 or higher. Entire communities in South Korea, where Terra had a particularly strong following, saw their investments wiped out. There were reports of people losing their life savings, of families in crisis, of despair spreading through online communities that had once been filled with optimism and excitement. The collapse of Terra also had ripple effects across the broader crypto ecosystem. Many decentralized finance protocols had accepted UST as collateral or had integrated it into their systems. When UST lost its peg, those protocols faced bad debt and liquidity problems. Some DeFi platforms had to freeze withdrawals or shut down entirely. The price of Bitcoin, which the Luna Foundation Guard had sold in large quantities to try to defend UST, continued to fall, dropping below $30,000. The entire crypto market lost hundreds of billions of dollars in value in a matter of days. What had started as a problem with one stablecoin had become a broader crisis of confidence. In the weeks and months that followed, the full extent of the damage became clear. Terra was finished as a functioning blockchain. UST was worthless. Luna, once one of the top 10 cryptocurrencies by market cap, was essentially dead. Terraform Labs and Do Kwon faced investigations from regulators in multiple countries, including the United States and South Korea. There were questions about whether the project had been marketed fraudulently, whether the founders had known about the risks, and whether they had taken steps to protect themselves while retail investors bore the losses. Do Kwon, who had been so confident and combative on social media during Terra's rise, went quiet. He eventually resurfaced with a proposal to fork the Terra blockchain and create a new version called Terra 2.0. But this effort gained little traction. The trust was gone. In the following year, regulators began pursuing legal action. Do Kwon was charged with fraud in the United States and South Korea. He went into hiding, and his whereabouts became the subject of international speculation. Eventually, in March 2023, he was arrested in Montenegro with a fake passport. The legal proceedings continue. But the Terra story as a financial and technological experiment was over. For investors trying to make sense of what happened, several lessons emerge from the rubble of Terra and Luna. The first is about understanding the mechanics of what you own. UST was often described simply as a stablecoin, which made it sound similar to Tether or USDC. But the mechanism behind UST was fundamentally different and far more fragile. It relied on confidence and continuous arbitrage activity to maintain its peg. There were no dollars in a bank account backing it up. If you held UST, you needed to understand that your token's value depended on the market's belief in Luna. And Luna's value depended partly on the demand for UST. It was a circular dependency, and circular dependencies can break catastrophically when stress enters the system. The second lesson is about yield and risk. 20% annual returns on what was marketed as a stable dollar equivalent asset should have been a red flag. In traditional finance, the relationship between risk and return is well established. Higher returns come with higher risk. There is no free lunch. When something offers returns that seem too good to be true, it is worth asking where those returns come from and what could go wrong. Anchor's 20% yield was not sustainable without subsidies, and subsidies eventually run out. Investors who chased that yield without understanding the underlying mechanics were taking on far more risk than they realized. The third lesson is about concentration and diversification. Many people had the majority of their crypto holdings in UST deposited in Anchor to earn that 20% yield. When UST collapsed, they lost everything. Diversification is not just about holding different assets. It is about holding assets with different risk profiles and different failure modes. If everything you own depends on the same underlying assumption or the same system, you are not truly diversified. A portfolio that is spread across multiple stablecoins, some algorithmic and some backed by reserves, would have fared better than one entirely concentrated in UST. The fourth lesson is about liquidity and exit. During the Terra collapse, many people realized too late that they could not exit their positions. The markets were moving too fast, the prices were too volatile, and in some cases, exchanges halted trading. This is a general feature of panics and crashes. When everyone tries to exit at once, liquidity disappears. Market orders get filled at terrible prices. By the time you realize you need to get out, it may already be too late. This does not mean you should panic sell at the first sign of trouble, but it does mean you should think about your exit strategy before you need it. How would you get out if things went wrong? How much could you lose before you would act? The fifth lesson is about regulation and consumer protection. The collapse of Terra highlighted a tension in the crypto world. Many crypto enthusiasts are drawn to the space precisely because it operates outside the traditional regulatory framework. They value the freedom to experiment with new financial instruments without permission from governments or banks. But that freedom also means less protection when things go wrong. There is no FDIC insurance for crypto deposits. There is no Securities and Exchange Commission overseeing stablecoin issuers in the same way it oversees traditional financial products. After Terra, regulators in the US and globally began paying much closer attention to stablecoins, with proposals to require reserves and regular audits. The question for investors is whether they are comfortable operating in a space with fewer protections and how they can protect themselves when institutions will not. The sixth lesson is about cult of personality and social pressure. Do Kwon was a charismatic figure who cultivated a loyal following. He was confident, often dismissive of critics, and portrayed Terra as inevitable and unstoppable. Many investors believed in Terra not just because of the technology, but because they believed in Do Kwon. This kind of founder worship is dangerous. Founders are human. They can be wrong. They can make mistakes. They can even be dishonest. Investing based on your admiration for a person rather than a clear-eyed analysis of the risks is a path to loss. Similarly, the social dynamics of crypto communities can create echo chambers where dissent is unwelcome and skepticism is mocked. Being part of a community can be valuable, but it should not replace your own independent thinking. The Terra collapse also raises deeper questions about the nature of money and trust. Stablecoins attempt to create something that functions like money without the backing of a government or a traditional financial institution. For a stablecoin to work, people have to believe in it. That belief can be grounded in reserves, in code, in reputation, or in shared delusion. UST's stability was always somewhat imaginary, dependent on enough people believing in the mechanism to keep it functioning. When that belief was tested, it failed. This does not mean algorithmic stablecoins are impossible, but it does suggest that the problem is harder than Terra's creators believed. Money is fundamentally a social and psychological phenomenon, as much as it is a technical one. In the aftermath of Terra, the crypto industry continued to grapple with these questions. Some projects abandoned the idea of algorithmic stablecoins entirely, concluding that they are too risky. Others tried to learn from Terra's mistakes and design more robust mechanisms. Stablecoins backed by reserves like USDC and even Tether, despite its controversies, gained market share. Regulators moved forward with frameworks for stablecoin oversight. The conversation shifted from can we create a stablecoin without reserves to how do we ensure that stablecoins with reserves are actually backed and audited properly. For you, listening to this story now in the quiet of the evening, the takeaway is not to avoid crypto entirely or to view all innovation as suspect. The takeaway is to approach any investment with humility and skepticism. Understand what you are buying. Ask questions. Look for the vulnerabilities. Diversify your holdings. Do not chase yields that seem too good to be true. Do not let social pressure or fear of missing out drive your decisions. And remember that every financial innovation, no matter how clever or well-intentioned, carries risks that may not be obvious until they are tested by real-world stress. The crypto market has moved on since Terra. New projects have launched, new bubbles have formed, and some have popped. Bitcoin and Ethereum recovered from the lows of 2022. The cycle continues. Terra is now a cautionary tale, a reminder that complexity can hide fragility, and that what seems stable can unravel with shocking speed. But it is not the only cautionary tale, and it will not be the last. Take a deep breath now. Let the tension of the story ease away. The markets will still be there tomorrow, Prices will move up and down. New technologies will promise to change everything. Some will succeed, others will fail. Your job as an investor is not to predict every outcome or to catch every opportunity. Your job is to protect what you have, to grow it slowly and carefully over time, and to avoid the catastrophic mistakes that wipe out years of progress in a matter of days. Rest easy tonight, knowing that patience and prudence, though they may seem boring compared to 20% yields and moonshot promises, are the foundation of lasting wealth. Time passes, markets cycle, and the investors who survive and thrive are not the ones who chase every new thing, but the ones who understand risk, who diversify, and who never bet more than they can afford to lose. Sleep well.